The Walt Disney Company trades on the New York Stock Exchange with ticker symbol DIS, and is headquartered in Burbank, California. The company was founded in 1923, but it was in 1957 when Goldman Sachs co-led the Disney IPO at a share price of $13.88 on the New York Stock Exchange. Disney's business is divided into 5 pillars. First, media networks and distribution, platforms from which they earn a high percentage of the group's revenue. Secondly, they also manage the famous Disney parks, as well as studio entertainment, consumer products and the interactive business. If we now analyze it from the market perspective, we discover that the stock raised up to $200 in 2021, when it made an all-time high, just in the middle of a technological bubble, from where it decreased rapidly to current numbers. Today, the stock trades at around $100, which is still almost 10 times more than in its transformation into a public corporation, but a 50% loss from all-time highs. The current master question is, are we still inside of the bubble? Or is it Disney are ready to buy stock for the future? Please hit the like button and continue tuned to this video. If we assist to the most common analysis fundamental, the price to earnings ratio, which compares the total market capitalization of the stock, which is sitting around $177 billion against the earnings of the company, which are $3.2 billion, we get a quite high value for our standards, which is near 50 times price to earnings. At least, one positive thing regarding PE, is that it is on a low place if compared to its last 2 years' fundamentals. For example, from August 2021 to February 2022, PE at Disney was above 100 times, twice as expensive as it is now. But, in a wider view, for example in 2018, PE was sitting around only 15 times, which is at least 3 times cheaper than today. Thus, in our opinion, this current valuation is not safe enough to ensure a good margin of safety, so, we would not invest based on this. Anyway, there are some positive points that must be mentioned, in case anyone is fully convinced of his own analysis. First, the expected growth of revenues for 2025, where Disney is expected to win around $10 billion for the year. This would mean, based on current market capitalization levels, that the stock would be trading at around 17 times price to earnings, which is really close to its safe low values of the last few years. Additionally, although debt levels raised during 2020 and 2021, the truth is that now they are coming back to more healthy levels, as, for example, 3.1 times net debt to EBITDA for this last 12 months. Further positive news is that it has currently surpassed Netflix in subscriber base, a thing that could boost up market confidence and thus capitalization during next months, and eventually exercise positively in future earnings presentations. In summary, and only in our opinion, although it seems to be a really solid and excellent business that has survived for ages, is not properly valued and has no safety margin for us to invest in it at the moment. Nevertheless, we believe that we will follow it closely and will see if it appears at any entry point in the midterm. Please contribute with a like and a subscription, it will help us to continue serving you, honorable investors.